Good afternoon, everybody. It is now Wednesday, March 23rd. And after a really dismal start to the month, we've actually had a pretty good last week and a half or so. In fact, last week we had 4 days in a row where the S&P 500 was up greater than 1% each day for 4 days in a row. Going back over 85 years, that's actually only happened 4 times in history where you've had that many consecutive 1% up days. So that's, it's obviously a positive. In the wake of that, the S&P has regained about 8%. The NASDAQ has rallied about 12% off the lows that were made about a week and a half ago. So all good news in terms of being equity investors. Against the backdrop of that, we still have interest rates increasing. That's been kind of tough for the bond market. But, looking at some of the metrics that we look at, here's some of the positives in terms of what's happening in the market. First, I've always said the market is not always the best measure of the overall economy. It is a great measure of liquidity. And so I get myself asking, what happened about a week and a half ago before we got this big rally? Well, the biggest news came out of China. China offered some historic stimulus and historic support to their struggling real estate sector, which eased some of the concerns that they had about debt in the property sector in China, which is absolutely massive. As much as we have debt problems here in the United States, and we definitely do, China has it in spades. So any relief to the issues that they have around their debt burden, particularly around their property market, was welcome news by investors. Also, you saw the market for bank loans. Those that also know me, I like to look at the market for bank loans because to me it looks at the risk premium in the banks, and it's a measure of stress anyway in the banking sector. Bank loans rallied last week, which was pretty good. The Federal Reserve has now come out and said they're probably going to raise maybe 50 basis points next meeting. They might even do it twice this year, and that seems counterintuitive to the world we've been in lately, where people say, wait a second, the Fed raising rates, isn't that bad for stocks? Well, kind of. We've kind of hit this point now where the Fed getting more aggressive from a policy standpoint is actually really good because inflation is getting out of control. It's turning into a problem. You do not want inflation to hit the point where it becomes demand destruction. And the Fed now has got to navigate that. They've got to navigate increasing rates without slowing the economy too much. And I think that the overall sense, at least, is that if they continue to stay on course, despite everything that's happening over in Europe right now, that probably in the short term there might be a little bit of pain in the financial markets, but in the long term it's a pretty good thing. The VIX volatility measure collapsed last week, which is a good thing overall as well. And also the amount of stocks that were basically trading above their 200-day moving averages, it's the advanced decline line, that's actually ticked up again. So you're starting to see more stocks advancing. So what are some of the negatives? I don't think we're out of the woods yet. This rally's been great. I hope it continues, but there's a couple negatives. First, interest rates are still going up. The bond market is still under stress. I think we need to see these interest rates sort of level out before this rally really gains legs and perhaps we can move to new highs. The other thing is another measure of stress in the banking system we like to look at. It's called the TED spread. Basically what it is, it's the spread of interbank loans over treasury bills. All it basically is this. The treasury bill is considered the risk-free asset. When the market is healthy, when the banks are sound and healthy, it's not really considered to be much greater risk in the banks than the overall treasury. When that spread pops, that shows that the financial system is under stress, as it would be right now, because you've got a lot of European banks wondering what their counterparty risk is over in Russia. You've got a lot of businesses in oil and commodities that are wondering what things are going to look like for them over the next year and a half as we've taken a lot of this commodity production offline with everything that's happening in Russia and Ukraine. That TED spread's still pretty elevated. It's above an area where we'd like to see it. I'd like to see that come in a little bit as well. And so those are the two storm clouds that are on the horizon a little bit that make me say this rally's great. Hopefully the lows are in for the year. We won't know until the end of the year, but there's some real positive stuff happening. Last piece too, I'd like to see the breadth, the depth of the rally be a little bit stronger. You like to see 90% up days. We got 70, 80% up days during this rally. What that means is this, a 90% up day basically means that 90% of the stocks in whatever index we're looking at, whether it's the NASDAQ or the S&P 500, are rallying. In the last week or so, we've had 70% up days or so. Those 90% up days are a real powerful indicator. S&P has been a little weaker than NASDAQ. NASDAQ, we did get about 85% of stocks rising, particularly the tail end of last week. That's a good thing. So, right now we're in wait and see mode, but all this stuff is good for sure. The balance sheets and the accounts all look a little bit better than they did about a week and a half or so ago, and we'll just see whether it continues. Still a lot of storm clouds on the horizon, some things that we've got to deal with, but hey, there's some good news out there that's happening right now, and we will take it. So that's all I've got for you today. If you have any questions, please call me or a member of my team. If you spent 5 minutes with me, thank you, and until next time, take care.